couple of weeks ago on the podcast, we talked about 8 Roth conversion tax traps. In today's Whiteboard Fireside Chat, we're going to break down one of those, IRMAA. We're going to break down what IRMAA is. We're going to look at a client example to see if they're going to be subject to IRMAA in 2026. And then finally, we're going to talk about tax planning opportunities so you can avoid the IRMAA tax trap in the future. But first, my name is Kevin Lau. I am the host of the Planning for Retirement podcast and also the owner at Imagine Financial Security. If you're over 50 and you've managed to save north of $1 million and now you want to learn about how to maximize retirement spending, minimize your lifetime tax bill, and worry less about money, consider subscribing to the channel and also consider following the podcast. We put out weekly retirement-related content specifically designed for you, PFR Nation. As you can see, I'm in my living room today doing the Whiteboard Fireside Chat. One of my sons is sick. He threw up just now, so I'm kind of watching him, and so he might be making a little noise in the background. And also, I have 2 dogs, so thank you for your patience on that one. But you know what? It's nice. We've got this nice fireplace here for the Whiteboard Fireside Chat. So why don't we dive in? All right, so this first slide we're looking at are the IRMAA brackets for 2026, okay? So essentially, to keep it very simple, everybody gets Medicare Part A for free. Everybody pays a baseline for Part B, and that amount is $202.90. And then whatever Part D, whatever prescription plan you choose, you pay that premium, okay? But there's no surcharge in this first tier, okay? We're going to break down, there's technically 6 tiers, 5 of which have the IRMAA surcharge in them. So the number that they're looking at is your modified adjusted gross income from 2 years prior. So again, these are the 2026 IRMAA brackets. So they're actually looking at your tax return for 2024. And that kind of makes sense because at the end of the day, nobody's filed their taxes for 2025. And this is not like the ACA premium tax credits where you're projecting forward what you think your modified adjusted gross income is. They're actually looking at your tax return for 2024. I don't know what would happen if you have not filed your tax return for 2024. If you know, drop a comment. I'd love to know what the logistics are. But assuming you have filed your taxes for 2024 and assuming you're going to be enrolled in Medicare in 2026, you're going to need to look at these thresholds. So essentially, if you're single, the first threshold, the first IRMAA tier is any income above $109,000. Again, this is modified adjusted gross income. If you're interested in learning more about how this calculation works, like I said, we're going to break down an example here in just a second. If you're married filing jointly, that first income threshold is income above $218,000, okay? The next tier, if you're single, it's income above $137,000, and then for married filing jointly, it's above $274,000, okay? So if you annualize the surcharge, so if you look at this second tier here, we're going to circle that one, and you have this additional premium for Medicare Part B, and then the surcharge for Part D. That's an annual number, if you're single, of $1,148 a year. If you're married and filing jointly, it's $2,296 per year. The third tier for IRMAA will cost, if you're single, $2,884 a year. And then if you're married, assuming both of you are on Medicare, that's $5,769 a year. So quite a jump from that first IRMAA tier to the next IRMAA tier for sure. And you might be looking at this and say, $1,148, that's not too bad. But you know what? Nobody likes to overpay the IRS, and especially since you've been paying into Medicare your entire career, being charged an additional cost just because your income is a certain level, that tends to tick our clients off. So again, this is why we're doing this video. This is why we want to do thoughtful planning looking into the future, okay? And so on and so forth. I mean, if you look at the last tier here, tier 6, I mean, now we're looking at about $7,000 a year for singles and then upwards of $13,872 if you are married and both on Medicare. So definitely not ideal. And again, we are looking at income from 2024. So why don't we actually do that with one of our client examples where they have several sources of income from 2024, taxable interest. They have dividends of about $17,850. They have distributions from their IRA. But I do want to point out here is that they took out their required minimum distribution in total was about $64,757, of which $6,000 was a QCD, qualified charitable distribution. That's going to be one of our planning opportunities that we look at the very end. So therefore, that reduced their taxable distribution from their IRA by that exact amount. So now their taxable IRA is now $58,757. They both have pensions, and those total about $112,000. They're both on Social Security, obviously, because they're RMD age, and they receive $95,000, but 85% of that is taxable, and that equates to $81,068. They had some capital gains for 2024, but we had done some tax loss harvesting for them in the past, in 2022 in particular. So they had some losses that they carried forward. And so therefore they were able to use those losses to offset all of their gains for 2024 and actually created a net loss of minus $3,000. Okay, that's the benefit of tax loss harvesting. That's the benefit of building up that war chest. If you remember, 2024 was a good year. Most likely, none of you had losses to realize in that particular year. However, in 2022, in 2020, in 2018, in 2015, in 2008, 2009, you probably had some losses. So if you capitalize on those tax loss harvesting opportunities, you could build up that war chest to offset gains in retirement in the future. And now they have a net benefit of a deduction against their income of $3,000. So that brings the total adjusted gross income number to $273,664. Now, I will note the modified adjusted gross income calculation, I did a deeper dive into this last IRMAA video in 2024, but the real simple equation for modified adjusted gross income is take your AGI, your adjusted gross income, and add back any tax-free income. So tax-free income could be income you receive from foreign income or interest from municipal bonds. Okay, this couple, they have no muni bonds. We decided to change their brokerage strategy once they retired because they used to be in the 32% tax bracket, and then they sold their practice, went to retirement, and then dropped substantially to 24. So we just use taxable bonds for them. They work just fine. Okay, so if you have taxable or tax-free income, you will add that number back. In this case, they don't have any, so their number for the Medicare surcharge is going to be looked at for $273,664. So if we feed that into those brackets we looked at for 2026, you can see they're in that first tier for IRMAA, so they will be paying this surcharge of $81.20 per year for Part B and then $14.50 per year for Part D, and then we're going to multiply that by 2 because they are both on Medicare. So that's going to be essentially a total surcharge for them of $2,296.80. Now, what you'll notice here is look at their modified adjusted gross income number, $273,664. Look what that next tier. If we jump into the next tier, they were literally, what is that, $336? They were $336 away from jumping into the next tier. That would have cost them about $3,500, okay? So if they had additional income from, let's say, taxable bonds, from dividends, maybe a Roth conversion that went wrong, they would be in that next tier, and that would cost them that much more in those Medicare surcharges, in those IRMAA surcharges, okay? But if you remember, they did a qualified charitable distribution. They should have been in this next tier for IRMAA, but because they gave to charity tax efficiently from that QCD, that reduced that taxable IRA distribution by, remember, if you remember, $6,000, that right there would have put them into that next tier. So that $6,000 QCD not only saved them the marginal income number, but it also saved them additional $3,500 a year in IRMAA surcharges. That's why you want to be intentional with this. And you're as you think through your income for 2025, we need to be thinking ahead for 2027. Because this is the tax return 2025 that's going to impact your IRMAA numbers in 2027. Real quick disclaimer, if you had a life-changing event and you feel like, hey, my income is going to be much lower in 2026 than it was in 2024 because of these life-changing events, you can go to form SSA-44. Just literally do a Google search, SSA-44. It'll pull up the form directly from the IRS website, and you can file this with Social Security and potentially have your IRMAA surcharges either reduced or waived completely, depending on what your new modified adjusted gross income projection would be for 2026. And you'll notice here, work stoppage is one of those life-changing events, as well as work reduction. So this is going to be very common for a lot of you PFR Nation, is that maybe you retired in 2025 and you're like, hey, my income was a lot higher in 2024 because I had wages, I had earned income. I don't have that anymore. So therefore, you can file this SSA-44 and you should be good to go. We've had a lot of success with our clients doing this. So just an FYI, that's also one of the little spoiler alert, that's one of the tax planning opportunities that we'll talk about here at the very end. So if we're in 2025, which that's when I'm doing this video, and we're thinking through, okay, 2024 is already locked in. 2026, it's basically more of a formality. There's nothing you can really do to reduce your taxable income in 2024. But for 2025, you might be thinking, okay, how is this going to impact my income or my modified adjusted gross income for those calculations for IRMAA for 2027? This is directly from IRMAA.com. At the end of the day, we don't know what the IRMAA brackets are going to be for 2027, but I would agree with these numbers. They essentially are inflating these by what they think the adjustments will be in 2026. They'll announce those at the end of next year. And so as you can see, they adjust these slightly by inflation, and you can see the IRMAA tiers are laid out right here, okay? So if you want to take a snapshot of this, or if you want to go to IRMAA.com, they have this posted on their website as well, what they think the 2025 modified adjusted gross income brackets will be, again, for those IRMAA surcharges in 2027. So what can you do in 2025 to plan for 2027, or in 2026 to plan for 2028? I'm going to talk about 7 strategies to keep that modified adjusted gross income in check. The first one I'm going to put on here is plan your Roth conversions before you turn 63. Because when you turn 63, that's the first year that they're going to be looking at that income for your Medicare surcharges. At the same time, that might impact your Affordable Care Act premium tax credit. So you need to really be aware of this. So yes, if you're 63 or if you're younger than 63, you might be thinking, hey, you know what? I'm not subject to IRMAA. However, you might be receiving premium tax credit. So I put this in here, just more of a timing for Roth conversions. And you really need to really think through, do Roth conversions make sense to me? If they do, just be aware of these potential tax traps, not just with IRMAA, but also with those Affordable Care Act premium tax credits. Number 2 I put down here is partial Roth conversions. Oftentimes I see folks looking at the tax brackets, the marginal tax brackets, and they say, you know what, I want to maximize the 22% bracket, or I want to maximize the 24% bracket. Okay, well, if that is the case, you might be subject to IRMAA if you cross over that threshold that we mentioned, that cliff that we mentioned in that previous slide. So not only determine, hey, what bracket does it make sense for you to optimize for Roth conversions? But if you fill up the entire bracket, does that trigger IRMAA? And if it does it make sense to do partial Roth conversions in order to mitigate or eliminate those IRMAA surcharges? All right, the third thing is, for all of you who are charitably inclined, and if you're over the age of 70 and a half, you have the ability to do a QCD, or a qualified charitable distribution. In 2025, this allows you to donate up to $108,000 directly from your IRA to a qualified 501c3. For 2026, the number is going up to, I believe, $111,000. And this is per individual. Okay, now, not saying you have to donate the entire thing, but as you saw that example that we looked at from that client for 2024, their $6,000 QCD saved them from going into that next IRMAA tier. So that's the kind of tax planning that you need to be thinking about in terms of qualified charitable distributions. And if normally you give $5,500 or $6,000 or maybe it's $6,500 to charity, but then you look at those potential 2027 IRMAA brackets and you say, you know what, if I donate another $250 or $300 or $500, that keeps me from going into the next IRMAA tier, that might be something you consider. And it is the season to give, so perfect opportunity to review your charitable giving strategy, not just for 2025, but in the future as well. The number 4 thing I put on here is interest income and controlling your interest income. It's very tempting now that interest rates for things like money market accounts or high yield savings are now north of 3.5, or even 4% they touched in 2025 and 2024. So it's very, very tempting to load up a lot of cash in your emergency fund, but that could create a substantial tax drag for you, not just on your ordinary income taxes, but on IRMAA. And that extra $300-400 of interest income might trigger the next IRMAA tier. So just be very, very careful with this. Not saying don't have any cash on hand, don't have any emergency fund, but just be mindful on how much you're putting in those taxable buckets that generate interest income. Number 5 is capital gains management. So we talked about the tax loss harvesting strategy, building up that war chest over the course of many, many years, and that could help offset gains either in that particular tax year or in the future. So very important strategy. But what I'd also say is some investments that you hold in these taxable accounts could trigger substantial tax bombs towards the end of the year, pretty much right now. If you look at some unrealized capital gains that are pushed out to you. These are called phantom capital gains. This could trigger an extra $30, $40, $50, sometimes $60,000 in gains that you didn't cause. You didn't go in and sell anything in your brokerage account, but because of those fund managers that are doing a lot of trading, they are selling off investments to raise cash to pay to their shareholders. They're rebalancing according to their active managed strategy that passes on capital gains, not to them, but to you, the shareholder. So be very, very careful. And we always talk about asset location. Own your tax inefficient investments in your tax deferred accounts, your tax advantaged accounts. And that's what we're talking about with capital gains management. So this next strategy we're going to look at is called bunching your donations, okay? And so you can certainly bunch your donations directly to one charity, but you could also bunch these donations into a donor advised fund. And the reason you might consider doing this is maybe you're making charitable donations, but you're still not itemizing your deductions because the standard deduction is so much higher than it was back in 2017 and before. So if you bunch donations into a donor advised fund or directly to charity, that could unlock your ability to itemize those deductions and other itemized deductions as well. Keep that income in check for that particular year where maybe you had an abnormally high income tax year. Maybe you decided to do a really big Roth conversion. You're like, hey, maybe I want to combine this with a donor advised fund or with some charitable donations, and you're not yet 70 and a half, so you can't do qualified charitable distributions. This is a good opportunity to consider. And then last but not least, number 7, this is cheating. You file Form SSA 44. Again, if you qualify for one of these life-changing events, you can simply fill out that form and you're not subject to any IRMAA, or potentially you could reduce that IRMAA tier that you were once in. That's it for today's video, everybody. I hope you all found this helpful, and I would encourage you, if you have not done so already, go check out that podcast episode that we put out a couple of weeks ago, 8 Roth conversion tax traps. It includes this particular one that we talked about today, IRMAA, as well as 7 others that you should really be mindful of as you're planning for retirement and to minimize your lifetime tax bill. Thanks everybody for tuning in, and we'll see you next week.